Yeah, so let me just go ahead and read this disclaimer here. I just pressed the record button. So again, welcome back to our 35th, 36th edition of our weekly Wook and Review broadcast. Just for the purposes of protecting ourselves from lawsuits, let me ensure everyone is aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So there's a lot of news out this week. My plan is to go through our prepared material one by one, and then that should probably only take 20 minutes or so. And then yeah, we can take the discussion wherever folks want to take it. So let me just get that pulled up. There's a lot of activity in the crypto space this week in terms of enforcement actions taken by the Securities and Exchange Commission. So we included a lot of that in this week's newsletter. So let me get my screen sharing. There we go. I'm going to go a little out of order. I'm going to actually start with that because I think it's major news for that industry, which I think a lot of people probably have a wide range of opinions on whether it's an industry that needs to exist or not. But we got earlier in the week the SEC suing Binance, included that lovely image that SEC tweeted themselves earlier in the week, the quote from the Binance chief compliance officer 5 years ago that, quote, "We are operating as a fucking unlicensed securities exchange in the USA, bro." That was the chief compliance officer's communication to the head of Binance, Zhao. So they they knew that they were breaking the law. They continue to break the law. SEC enforcement has obviously been something we talked about a month or so ago, as they've kind of been picking up the pace of the enforcement action. So this week we got both the action against Binance, where the SEC alleged that they didn't have necessary controls to prevent manipulative trading. They were allowing for securities to be traded on their platform, et cetera. And then just a couple days after that, we got the suit against Coinbase. So, of course, Coinbase is a publicly traded company, ticker Coin, that came public a couple years ago. I think it was 2021 via a direct listing. So Coinbase is upset that SEC, they say, shouldn't have allowed them to do that if they were in fact illegal. That seems to constitute a lot of their pushback. There's definitely, it's an existential threat to them and their business. The SEC basically asserting that it needed to be registered. It being Coinbase needed to be registered as an exchange and have the appropriate federal oversight, which it did not, as well as the staking program that the company offers was an additional unregistered security offering. So, Coinbase, unlike Binance, is heavily oriented around the U.S. The vast majority of Coinbase's revenue, over 80%, comes from the U.S. So whereas for Binance, exiting the U.S. market and potentially continuing on ex-U.S. is an option, it does not appear that that is the case for Coinbase. So Coinbase is expected to litigate. One analyst said, quote, "Expect Coinbase to litigate this vigorously. It is alleged that virtually their entire U.S. business is illegal." So included a timeline of just all of the craziness that's happened in the crypto world going back a year. I'll be quite honest, I don't follow it like a hawk. I've always thought that it was kind of a grift. I'm happy to see the enforcement actions, and I'm very curious to see what will likely end up being a Supreme Court decision on what kind of, how much does SEC win, how much, if at all, does Coinbase win. But it does certainly seem like litigation that ends up in the Supreme Court is the final resting place for this uncertainty that is floating around these unregistered uh, token exchanges. So, yeah, again, format wise, if anybody in the audience wants to talk about or share any insight or commentary on this topic, the enforcement actions taken by SEC against these unregistered securities exchanges, please just raise your hand, come on up, chime in. Otherwise, if I don't see any of that, I'll just keep going through the prepared content, and then when we get to the end, folks can come on up as they would like. So again, I went a little out of order. Second item that Joe included in this week's newsletter is this discussion that by the most basic or by one crude definition, the stock market has re-entered a bull market. This idea that a 20% move off of a low level implies a new bull market. And we talked a lot last week, and we always, I think, tend to talk about this stuff, the importance of separating financial markets from the real economy. So I would just point out, there was a couple good graphics I saw this week, kind of in line with, we've got this just massive resurgence in the technology sector, this massive outperformance year to date. The tech is up almost 45% from the bear market low. NASDAQ's up almost over 33% year to date. One thing I'll kind of call out that I saw called out by a couple of investors I have a lot of respect for earlier this week. So I'm looking at the price to earnings growth ratio, and I had seen it shared specifically for technology, but I'm looking at the S&P 500 writ large, which, as we all know at this point, is plurality technology anyway. And what I find interesting is that while price to earnings ratios are not astronomically high, the price to earnings growth ratios are astronomically high. So what investors are paying for relative to the growth that analysts expect to see over the coming years is really at extraordinarily high levels. The willingness to pay these high prices relative to future earnings growth, it's an extraordinary time. So it just gets back to this notion of, is AI going to lead to massive improvements in company productivity, profitability, margins, et cetera, that enables more growth to come into play than is currently estimated? It's absolutely possible, but it definitely is not good if you're hoping, or if you're thinking that if things continue on as is expected, that forward returns would be attractive. So obviously it's a general statement, and I wanted to appreciate you coming up, and always happy to hear you chime in. I'm certain that within the sector and index, there's of course opportunity, but more of a broad commentary on the relative richness by which the indices and that sector in particular are trading relative to expected earnings growth. Monative, happy Friday.
Happy Friday. Hope you had a wonderful week, Rod.
Thank you. It's good.
Yeah. So, just a quick comment. I'm still in listening mode. We can always talk when you open it up. It's no need to get in the way of nice monologue here. But yeah. I mean, I don't disagree with anything that I've heard you say now. But the one thing I would say is just qualify that. It is AI going to make a difference? It is, to a small number of companies now, and slowly a growing number of companies down the road. The question really is it enough to move the needle for those companies? And are we seeing anything to suggest that just a simple example, right? I've used this example multiple times. Microsoft's up what $700 billion in 6 months on the on their co-opting chat gpt into everything. So let us even stipulate that Microsoft is going to be a big runaway winner at some point in time. What point in time is that? Is there enough revenue coming up soon enough that it justifies that run now against overall weakening potentially? So that's how I look at it. I mean, I'm not negative on Microsoft. I'm just trying to use that as an example to add on to what you said. Is even where there are very good reasons to assume and to even see that AI is going to make a difference, you got to be careful and see when is the difference going to be made, and what is the actual impact. Is that enough large enough of a difference to move the needle, or is it already run ahead of itself, right? The one exception certainly is by any stretch is Nvidia, because they are getting revenue today. They are making hay while the sun shines. Right now, they are selling anything they can make. They are grabbing capacity that was available from other companies' misery, from TSM. They're grabbing all those capacities, locking it down. So their run, as much as it has happened, could go on for a bit longer. I do not have a position. I'm not recommending one, but I'm just saying out there that they are currently doing something very positive, and they are beneficiary of this today. But it's rare to see much beyond Nvidia and a handful of others, to see whether any of that run is already any of the run they've had is justifiable under a weakening economy.
Yeah, it definitely is a good point, Mon. That, like, when you look at Microsoft, but it's trading at like 25 times forward operating income, and you have to expect, right, if you see a forward price to earnings north of 30, which is what Microsoft has, that really meaningful growth is going to continue for a meaningful period of time, which it just becomes a rule of big numbers thing to me when I look at these multi-trillion-dollar companies. And it's like, I think it was last week we were talking about, how does NVIDIA say, it was Ted, actually. I think you made the point, maybe it was in the book club, um, about, if you want to see it go up, 4x over 10 years. So, okay, that means that, what does the exit multiple look like in, 2033 or whatever, and how much, income are you generating? Like, you need to be talking about many hundreds of billions of dollars in operating income, if you're going to slap these very hefty multiples on these companies to get to these many, like, you're talking about many of these companies being forecasted to be larger than most of the countries in the world. In some of them already are, right? Apple, Microsoft certainly are, but the continuation of meaningful growth is the challenging part. And yeah, I mean, you're right. It's obvious that Nvidia is a huge winner and is going to be a huge winner for some time here. And how much is that worth? And we can all kind of argue about that one. But it does seem like a lot of companies, right? That I see companies like we talked about, the ticker AI, I think last time, right? They're a machine learning company that, they're going to masquerade. And Monad, you shared your experience with, knowing the guy who's the head of it, who's a great salesman. But I just wonder how much is just like we're in a hype cycle again, right? The institutional investors are back at big time bullishness in terms of the NAIM survey. The VIX is back at the lowest levels seen since before, you know the COVID hit. There's a lot of um, excitement and euphoria, it feels like. The fear and greed index back in extreme greed. Like, there's a lot you can point to, but it does seem like a big part of it just is the simple fact that a lot of institutional money doesn't want to get left out. So there's been some FOMO piling in, and it's not just institutions. There's retail too, but I think a lot of times people like to say it's all retail, and very clearly it's also institutions. So yeah, I mean, all that to say, it's a very difficult, I think, environment. Um, if you're truly trying to think about making these long-term investments with so much uncertainty, you're not getting a great margin of safety, I guess, is my point on a lot of these technology companies if you're investing in them at these current levels. But Jimmy, you came up,
Yep.
and Jiro, you came up. So let's maybe keep the conversation in this sphere. You guys, Monica, appreciate it. Would you guys push back on that notion that there's not much of a margin of safety in technology, or am I off base there?
Hey, good afternoon, Rod. Good to speak with you. I joined a little bit late, so I was just listening to some of what you guys said. But if you think there is really a new bull market, I got some other things to sell you. Clearly, more companies at 52-week lows than 52-week highs. Market breadth is terrible. PEs are super high, led by what we just discussed. Um, the macro picture continues to deteriorate. Student loans come back in September. We got to get through some things, right? I think that for a long-term investor, I'm trying to hedge the downside, and I think a lot of that mentality is kind of fueling this VIX compression, where people are selling protection, and the market makers are kind of feeding right into that. I don't know where the next 30 days goes, but um, you know, VIX at 13 is pretty incredible, right? But I don't know that it's going to stay there. And VIX 13 at this S&P level versus the prior VIX 13, from our 2020, 2021, I don't think you even got there. But it's a tricky spot. And frankly, I still think it's a bear market rally. Incrementally, I'm getting shorter. You know, I don't think it's like a November 2021 short opportunity, but I do think, on the margins, much better to sell a lot of things. And frankly, the pro cyclical stuff hasn't been strong. The profitless tech stuff hasn't been strong. SPACs, no.
There was a
Crypto,
little bit
no.
of that beginning of maybe a broadening out in rotation, kind of at that tail of last week and beginning of this week, right? We saw
Yeah.
IWM start to have a couple nice big days in there.
And that's typical of like the end of the squeeze, right? You have like the low quality capitulatory short covering. We saw how consensus was so hated on the QQQs, and they've been short covering for their lives. But there's some really interesting days where like small caps, IWM, and QQQs have had this reverse in correlation where people have been, through the top, they've been short both, but more recently, year to date, they've continued to short the underlying basket within IWM, but people have been piling on to QQQ. Um, so, but still, I think if you have a 3-year time horizon or a 5-year time horizon, I don't know if you guys do, but it's just it's not a place where I'm deploying new long capital.
Are there places that you see as attractive for new long capital presently? I know you said you're getting more
hmm
short in some areas.
You know that I'm a degenerate gambler, and I have my track record to show for it over the last 2 years. But if I'm an institution, if I'm a family office, I'm looking at this like 12-month CD, right? 5.4% yield. Where else can you deploy unlevered cash yields? I mean, to get that return, you can't do that in real estate. And if you're a large institution right now, I mean, you're getting paid to wait a little bit. I don't know that I want to be along for this ride. Um, you know, yeah.
Yeah, I've made the point, Jimmy, on my Twitter, my personal account, that obviously institutions, it's a little bit different in terms of the dollar amounts they're handling, but 3-year CDs, 5-year CDs, you can still get around 5% interest rate. You can lock in that fixed rate, non-callable CD, which should be a pretty nice positive real return over that duration. I think most people are coming around to the reality that much of the inflation was likely transitory, right? And yes, there's several reasons why some of the underlying pressures for inflation are greater now than they were before the pandemic hit, um, which we've talked about in the past on here. But it's still too high, right? And it's expected to come down. The expectations of both the Fed, of, I think consumers, if you look at kind of the New York Fed survey respondents on what they think inflation is going to look like over 1 year, 3 year, 5 year, people expect inflation to come down, and maybe that PCE number is still too high, right? Maybe it's 3 as opposed to the 2 that the Fed wants, and then the question becomes, what do they need to do to get that last bit? And is it okay if PCE is sitting at 3% if we have a full employment economy and things are humming along just fine in the underlying real economy? I mean, those are definitely the questions I think the Fed will get faced with as we get deeper into 23 and start in 24. Yeah, Mangadev, go ahead.
Yeah, I just wanted to clarify something. So I'm actually not bearish. I am neutral on areas that have run a lot, and I'm taking profits in tech. But I'm not by any stretch bearish. There's plenty of places that I can still see, money moving into. Right? We've talked about industrials and defense, which Rod, you and I
And I
like.
think cyclicals, I
I
saw that
Correct.
pro allocations were at like the 1 percentile, something
Correct.
extraordinary.
So I am seeing, I watch the mark signals among other things. If you go, zoom out a little bit, the both on the cyclicals and on the and on the risk on sectors, we're really not seeing breakdown of the rally yet, right? It is sort of topping out on dailies, but if you go weekly and monthly, the rally is still just fine, and we finish the week okay here. So I'm looking at the weekly signal right here as we talk. It's not bad. So the point I'm trying to make is, yeah, there is, for people that want to play it safe and stay on the sidelines, certainly, the bonds offer enough yield. But we are quickly going down on inflation. I don't see inflation as a huge problem for much longer than maybe a few more maybe a meeting or two. We're not. I mean, I'm not in the I'm not in the deflation camp. We're not going to go negative inflation here anytime soon, but we're not going to see prices go back down anytime soon. But I don't think we're going to get into a disinflation pretty quick here. So I am still very positive on sectors where I know the macros lined up, right? Like we've talked so many times, there is so much industrial construction going on in the US. There's so much factories being built there. The defense budget is locked. It's going higher. It's not going down. We're building new defense capacities. Large orders are starting to flow in. Why would I want to sell that trend? Why would I want to go against that trend, right? So there's a lot going on if you're willing to pick through the noise. What I did, the earlier point I was trying to make was, yeah, I think, Microsofts of the world have had their run. I think it's time to, take a bit of profits there and reallocate it elsewhere where the run is a lot less or non-existent in many cases this year. So that's how I see it. I'm not negative on the market. I'm negative on individual stocks and pieces of parts of industry, yes, but not on the on not on everything.
Makes sense. Jiro, I know it's a little later by you. Nice to hear from you.
Hi there, Rod. Yeah, it's 9:30. All good, no problem. Yeah, today I have a micro question for you, Rod, because of Apple, because you are
Oh,
renowned
you're
for
gonna
owning
remind
put
me
options
about
on
my
Apple.
Apple losses.
No. I'm just very curious, like how you perceive the new, what is it called, the new
Oh,
Apple
the
glasses.
yeah.
If
Vision
it can
Pro.
be such a game changer, right? Because we discussed the valuation of Goldman, right?
Right,
Where you said
right.
it's bonkers, right? The valuation that they had. Would that change your opinion? Like if I mean, it will not
Look
become
at
the new iPhone
right,
immediately, right?
right.
But maybe a new toy going
I,
forward.
So I think we glanced on this earlier, the comments I was making about the sheer size of both Apple and Microsoft and what's needed to move the needle. So, even if the device sold a million units, and I don't know what the gross margin is, let's call it 50% gross margin, whatever. It's probably less. But yeah, it's just not something that moves the needle. But I agree with your sentiment that is the view that longer term is VR, AR the next paradigm that 5 years from now, 10 years from now, consumers will be using headsets instead of phones to conduct most of their internet activity. I'm not sure about that, but I guess my thought would be there was no possible way that any VR AR product they released was going to move the needle enough when you're already talking about what is Apple's market cap right now? It's $2.85 trillion. So you know they're still an iPhone company. They will be an iPhone company for many, many years to come. And I tend to think, I own both put options, and I also opened a short around 180. Well, it's right around what the price is now. So I'm also short shares in my personal account. It has nothing to do with Wook. And look, you're going to get. I mean, the business's cash flow yields are right around the 10-year Treasury yield. Like, just don't understand. I get flows and I get passive and I get all that. I just don't understand what person is saying. And look, Warren Buffett was buying it recently, so I'm clearly have an opposite view of him. I also think he's wrong when he says that people would give up $10,000 to use Apple devices for the balance of their lives. I have all Apple devices. I have since high school, and I would gladly take $10,000 personally, and I would happily use Google devices. But that's just me. I think that my issue with the headset is just that how do you move the needle? And there's no way it can move the needle for a long time.
Yeah, I don't know. I just thought because AI is such a big game, how do you say, a big game changer. They will. I mean, I don't know how yet, right? Because at the moment it seems like it's more like a toy at the moment, right? I mean, it's nice that you don't have to look inside a phone anymore. You can make the screen as big as you want. You can build a virtual cinema inside your living room, right? So at the moment, it feels more like a toy. But like if it really becomes like a tool, let's say in the business world, let's imagine all the offices, yeah. And instead of having and imagine a trader actually in a in a bank, in an investment bank, right? Instead of the 6 screens, they might have this like these glasses. I think that could be a huge game changer. I mean, in theory.
I had seen a couple. So Monative and Jimmy, I'll let you guys. I saw that you put your hands up. So I'll let you guys chime in. But I had seen a comment made. So I've never worked in that role as a kind of trader. I saw a few people who have made comments along the lines of, could you imagine having to make like a rapidly move in or out of a position, and you're kind of moving your head back and forth. And I don't know, the notion I got from what I was reading from some people is that it just doesn't seem realistic that people would be able to replace kind of the existing work function with those goggles. But that was just what I took away from it. So let me pause. Monitor, please jump in, and then Jimmy, please.
Yeah, I don't know how many of you have actually been involved in the build out of a trade floor. I have. When I was at WAMO, I built out their New York trade floor and one in South Carolina. Uh, Traders, take all kinds of risks, but not with their gear. So they are extremely risk averse, beyond any logic risk averse as far as software and technology goes. I have spent literally 100-hour weeks with my team trying to get a sign off from the head trader just to go live, just to start the cutover process. It goes on for dozens and dozens of rounds of testing, and they find something they're not happy with. And if they don't know for certain, they default back to, let's stay where we are, we can push this away. And push this away meaning, I don't want to meet you again till, till I'm ready to meet you. So you probably will see this coming in, but not so much to trade floors as to, traders desks, maybe like a head trader having, some less gear in his room, so his corner office looks more presentable than like a, mini data center. So you'll see this starting to trickle in, but not for actual, trading use, like Rod was saying. It, this gets complicated fast. You can't be moving your eyes around trying to find what you're looking for to hit that sell or buy button, and then you looked at the wrong thing and you've lost context. It could cost you tens of millions easily, right? Heck, Citibank makes mistakes in trades even without all of this. So I can't
Oof.
imagine, they probably sync the, Nordic market twice a week if they do this. So, yeah, yeah. I mean, but going back a little bit, Jero, this was my earlier point about Microsoft too. One, this is not even out this year. This device is coming out sometime next year to the public. So they'll probably, push it out to their influencers and create a big hype. Whether this actually moves the needle on revenues, I think we're a long way off from figuring that. But I wouldn't be surprised if it sells more than, what targets are being thrown around. It still might not move the needle, but it's Apple. It's a cool product. There's enough people with, $3,500 to blow up, so they will buy. My real worry is, it's happened with um, Facebook's Meta's device, is physical exhaustion and nausea and, and bad, feelings in the head. That's kind of stuff, right? You're putting something on. I mean, this is a country which rebelled against masks, for heaven's sake. Are people going to wear this for 8 hours to, do their thing? I doubt it. Not the first iterations. Anyway, I'll shut up.
It's okay, Monolith. You can see their eyes, so people will. I'm just kidding. Jimmy, go ahead. Jiro, I see your hand up, and Brendan, I know you came up, so let's go those three.
Hey, I think Monative made some really good points, took away all my jokes. Yeah, can you imagine using your virtual hands and hitting buy instead of sell? Like, compliance would never have that.
Citibank
Some
makes
of,
that bad finger, all the time.
yeah. One of the things I think about, not just the refresh cycle when you have that kind of a high margin product and you see the Oculus drop off and, forking up $3,500 only to have to buy version 2 in a year or two is, if you're a parent, you got kids, you can't get more than 15, 30 minutes by yourself. It just, unlike the phone where the barrier of entry to usage in a public setting is a lot lower, like this is something that's still, in my opinion, maybe there's a productivity element to it at work, I don't know, but for recreational purposes to build the ecosystem, if they really want to get more adoption, I mean, the people who are using it now, if you're in your 20s, you don't have kids, whatever, wait 5 years, wait 10 years. It's just, I don't see that critical scale. Again, maybe I'm biased, but it's just that type of usage is, at best, it's maybe 30 minutes a day. You get those glass marks on your face. It's the whole thing is a little too much for me.
And Jiro, before you chime in, I added comments in case folks didn't see Zuckerberg's comments yesterday. So I put that in the pins if people want to see what he had to say internally. Jiro, please.
Thanks. Yeah, so great points by Monative and also by Jimmy, actually, with respect to trading. I actually didn't think about that. Yeah. I mean, you're totally right. I mean, that would be super scary. But maybe like from an analyst point of view, right? If I imagine working with very big data frames, right, where you have, and that happens so often that you have data frames with I mean, okay, the number of lines is always super long, right? You cannot see all the rows in a data frame, but the number of columns, right? Like if you have like a huge data frame that you work with 50, 70 columns, and you can put on the glasses and you can see almost all the data frame. I mean, I see a little bit of use case. I mean, in the end, it's still a toy, right? Because I can also work on the same data frame with a tiny laptop as well, right? It's just a little bit more convenient, but it's the same with the Herman Miller chair, right? It's the same. It's the same in the office. Do we need those chairs? No, but it's just more. It's just nicer to sit on those, and we can sit longer on those. But I also agree that the glasses will not be mature, especially the first version. I'm sure. How do you say? Because I'm sure, as Jimmy said, that probably you can only wear it for half an hour, 1 hour maybe in the beginning, right? So it needs to mature. Maybe the fourth, fifth, sixth generation could be one where you can wear it during almost the whole day, I guess.
Thanks, Jiro. Brendan, hey, go ahead.
I was just gonna say, like, I see its usage and like its success in a different, sort of in a different light, more like the engineer in an office, right? That like was spending 6 or 7, 8 hours in front of a computer screen that now is like a $3,500, you know what I mean, productivity enhancement. Like, I'm not saying it's that developer instead of working. I'm saying this is phase one. This is the first time we're seeing it, right? And we're already starting to envision like the ability to like, do multiple things in terms of like see multiple screens, right? You could throw up 20 monitors of whatever you're working on, right? Like it's a computer in and of itself. I don't know if you've seen some of the like the videos afterwards, but you could basically take any of the other screens you're working on. So like your MacBook screen, right? Even though it's not this screen, and you can visualize it and create, a full room full of monitors of it for you and interact with it, right? So like to me, it's not necessarily the person at home that whether or not they're going to spend $3,500. You know what I mean? To me, the more interesting conversation is like, where is the actual, right? Like the person that and or the demographic of user that makes this thing, you know, really needed, right? Really desired. And it's not just that person at home who wants to just kind of use it and replace the iPhone, right? The iPhone hit a point where it wasn't just desired, it was needed, right? And I think that we saw those in our everyday live applications, right? Our problems were met with solutions on here, and that's when I think the difference changed. When we have problems that are met with solutions through this, I think that you'll see an easy justification for $3,500 by those that are getting much more than that worth of productivity.
So on that, right? Yeah, I get it, right? I could think of a lot of cases, right? Adobe was mentioned. So creatives would be a massive use case when people are editing, massive, video files that, they could see, the entire frame, across, massive wide monitor swath, right? So I see a lot of use cases like that, but it's still going to be, well, one at 3500, that's like a whole that's like a fully loaded corporate computer. So it's going to be a budget issue. It's going to be very selective spend of that money. And IT typically is very risk averse in these things. There is you know a need to understand the life cycle of this before they can say, what, if it's 3500 a year, it's not going to fly. If it lasts 3-4 years, it's probably a no-brainer. So the answer is somewhere between that, right? So,
I think
so
the
that
engineers building for it though is the answer there, right? Like if you get one or two of them in the office, and then those,
yeah,
that's able to be built upon because you can understand even internally what you might be able to do if your whole team had, capabilities within here. I think that's where the developer ecosystem
yeah.
in terms
So
of
so
was
that's a
built.
different use case altogether, right? Because that you spend, let's say 20 of these devices to generate millions in revenue from, the output of that. So that's a very easy justification. So yeah, you're going to find those unique cases where it sneaks into the corporate world very quickly. again, which is why I think this is going to surprise on the number of units sold more than people think. But it's probably still not going to, move the needle enough for Apple at this point. It's just what, $350 billion revenue. I mean, even a million of these is 3.5 billion. That's 1%. So
I read
it's
they
going to take
adjusted
time.
Exactly.
numbers to
But
127,000.
yeah, I think Brendan, though, you make the point that if it adds to productivity, then that right there, it'll pay for itself pretty quickly. So,
Yes.
we're going to get to this world where we're all sitting in our autonomous cars. We're putting our Apple Vision Pros on while we go to work. We're getting hours of work done in the car. Who knows? Maybe that's the glorious future we're
I
going to
mean,
find
we used to
ourselves in.
laugh about the fact that we would have a laptop and an iPad next to us at all times, like no matter where we were, right? Like, no way, not while you're on the train or traveling or commuting, and now it would be absurd not to, right?
Mhm. There were two, so I'm gonna steer us away from this one because there was two other topics. One I did not include in the newsletter that I will. You guys know I love talking about electrification, so I wanted to go there since Bloomberg New Energy Finance put out their annual electric vehicle outlook. So I wanted to talk a little bit about that. Before I segue there, um, I did want to spend a minute or two in case anyone had any thoughts on GameStop, right? We covered their earnings call, or rather, we were going to cover what would have been an 8-minute transcript, but was instead canceled on Wednesday as the company fired its CEO and named Ryan Cohen had already been the chairman of the board, but he's now been named executive chairman. They reduced the board size down to 5. They eliminated the strategic planning and capital allocation committee and have effectively consolidated all of the power under Cohen, who the board is him, 3 people that he has longstanding relationships with, Jim Grube, Alan Atal, and Larry Chang. What is next for GameStop? Really, to me, it's almost like a public it's just a pot of money that's a bet on Ryan Cohen being able to find some accretive M&A to me at this point. So I wanted to bring it up since we had hosted the call. It is in the newsletter that's pinned, the link if you want to catch that replay. So I don't want to spend too much time talking about it, but it's still clearly fascinating to a lot of people. So I thought it was worth bringing up. But I mean, that's kind of the way I see it at this point, is that any upside or even any justification for the curve valuation would effectively hinge on some highly accretive M&A activity. Agree, disagree? Anyone care before we go on to EVs?
I mean, is there even? I don't think there's another option. So yeah, I agreed. We'll move on.
Okay. So Bloomberg puts out an annual they have BNEF, which it used to be New Energy Finance. Bloomberg, I don't know when it was, 10-ish years ago, acquired them. But they've been putting out these electric vehicle outlooks, and I have on my screen, again, if you're following along, the executive summary. You can go and download the executive summary for free if you're not a client. A couple kind of interesting call outs. They're trying to make the argument that by 2030, in their forecast, the cost per, they're using kilometers, not miles, but the cost per kilometer of a heavy duty truck for diesel versus battery electric, it will be cheaper to operate a battery electric heavy duty long haul truck by 2030. They're obviously expecting some pretty hefty continued adoption of passenger vehicles, which a lot of that's being fueled by very accommodative regulatory policy in China, Europe, and the US. Yeah, I don't know if anyone had gotten to go through that, or if you're a client had gone through the entirety of the model. I like to follow it. I made a point a couple of months back, last time they'd updated their survey for battery pack prices. Prices had ticked up for the first time. There had been this decade plus long incredible cost curve decline for battery pack prices, and This past year, because of the input prices of the commodities rising so much, that trend had reversed for the first time. So a lot of the adoption is it hinges on that you have to get to superior cost of operation such that the economics are compelling for users who, especially fleet users who care only about their total cost of ownership to switch and adopt. So it was interesting to see that even by 2030, they're just about at parity with one another on the heavy truck side. And those medium and heavy commercial vehicles are a big chunk of CO2 emissions. I mean, it's about a third of the emissions coming out of the transport sector come from those heavy vehicles. So, yeah, we got other news this week on the electrification front, right? We got the two big American legacy OEs opting to move ahead with adopting Tesla's charging, what is it, the NA, I don't remember the acronym. They're going to go away from what is the combined charging standard, the CSS, and they're going to shift toward Tesla's charging standard on their vehicles. And GM and Ford vehicles will be able to use Tesla supercharger network in North America in the coming years. I had seen a headline that it was something like it was several $1 billion of benefit for Tesla through 2030. But I guess the part that I'd raised for the panel is I heard the Tesla bulls for a long time talk about the supercharging network being a competitive advantage for the company. And I guess if now the network is accessible to all, is that still the case? So I guess a couple different things there, but electrification, any thoughts on some of these news items?
Yeah, I saw that bullish note from Goldman about the 25 billion revenue run rate for supercharger. I don't get it. I mean, that assumes so many things. One, there is a cost to the supercharger. That's basically, your input cost of electricity, which is very difficult to determine without, knowing the state of the economy, the price of oil, the price of alternate fuels, the capacity, the time, the season, so many things. They come with a simplistic number of, we've got so many, EVs, and they are expanding at this rate. And if this percentage of them use the Tesla supercharger because it's widely available, this would be the revenue. I think that's way too simplistic a model. I think we're gonna find out that there is a good revenue stream to come, but it's nowhere close to that 25 billion.
And the vast majority of consumer automotive users are completing almost all of their charging at home. It's north of 90%. So I agree. That number seems really high to me.
Yeah, or work, right? Like when I was
Yep.
working at Adobe, the only reason I bought of course, I bought a cheap Nissan Leaf. The only reason I bought it was I had a short commute and they had free chargers. I'm not, I'm not going to plug it in at home and spend my own, electricity and pay for it. Again, right? These are, I'm really surprised seeing this from Goldman. I think they should have put in more time. There's probably some urgency to get something out in front of something else, some other, fundraise or rollover of debt or something else that's coming from one of these three companies, right? So I don't know why they got it out, but again, it seems to be the story that's oft repeated when Tesla is involved, is that they take the TAM under the best of circumstances and extrapolate that with the best of with the lowest of risk, and they call it a valuation based on that. I mean, you've got to. I'm not. I'm neither short or long Tesla, by the way. I'm just saying that month or 3 months ago, before the last earnings, we had these massive spaces that would be held to talk about how Tesla energy, the TAM was so massive. And I started looking into some of the data. I mean, the capacity of the gigafactories is far greater than the entire capital spend of all of the peaking power plants. So that's not the full TAM. Then okay, fine. Do they go out and sell, replace every generator that's out there? Yeah, it also exceeds, the total sales of generators plus the capital expense of the peaking power plants. This is where things start to break down for me. I think people throw out these numbers based on an absolute complete control of the market under the best of circumstances. I don't believe that's the case. Now, if the thesis is less about Tesla and more about the prospects for somebody, a competitor like Plug Power, yeah, I get that. I think they're dead in the water, right? So that is where I would use uh, Goldman's data to see who is really screwed if this comes to fruition, or even a fraction of it, rather than seeing this as a big positive for Tesla itself.
And just to build on what you just said, Blink charging was down a little under 11% today. ChargePoint Holdings down 13%. So the other charging network companies were the ones who really took it on the chin. Tesla stock was up, of course, 4%. So the market saying this added $3 billion to the present value of all those future charging cash flows.
Well, we'll see, right? I mean, I think you're going to see a lot more of, more detailed. I mean, I was surprised last quarter um, that Tesla did not actually spend that much time talking about their megapack business. I mean, it's growing fast, but it's growing from a non-existent base. So of course it'll be big numbers. So, but I think there is a future to that business. The question is, again, as with all things Tesla, is how do you value it? What multiple do you put on it? What growth rate is realistic? And what's the actual TAM? But if you say those things in a Tesla room, you probably going to get shot, then questioned, then derided, and then shot again. So it's not worth it.
It's definitely, from today versus a year ago, like pre-passage of the Inflation Reduction Act. I mean, I think it was last week too. We were talking about how much, in terms of the per kilowatt hour tax credits, going to cell production and module production. So there was another Bloomberg article talking about how many billions of dollars of credit value is coming to Tesla from that over the coming years. It's hard to understate, I think, how, look, the way I see it is this business is a function of government policy. The business wouldn't be here today were it not for government policy, and government policy is continuing to prove to be a major tailwind for the business. So while I do have a small short in my personal account on it, I recognize that it will not go to zero. It's not. I'm not a member of Tesla Q. I think they ended up being wrong. They could have been right. But again, your point about like what is in fact the value of a company that's still chiefly a car maker, which has unique attributes. Of course, your point about stationary storage and the fact that unlike most other automotive makers, they are able to sell software like margins for add-on products, some of which are perhaps not legal, but regulators have been loath to get in Elon's way, lest he tweet about them. So, I mean, it is interesting. Your point about the Nissan Leaf is actually a funny one. I've mentioned before, I bought in 2010 a hybrid. I've driven a plug-in hybrid for most of the last decade. So I've lived that, and also I mentioned my time at Ryder was hyper focused on how electrification was going to impact the commercial vehicle industry. So we're just yet to see that really on the commercial side, even with IRA throwing up to $40,000 per new truck. You're just not seeing the OEMs really uptick production. I've made this point in the past that these production plans take many years to kind of put in place and get ready to produce at the quantities that people maybe want. And I've made the point that I think that legacy parts players that have high returns on capital, high margins, whether it's turbochargers, GTX is a favorite. I know of, he's not in here right now, but our friend Bill, the lovely Patrick, he's mentioned GTX. I've mentioned Allison Transmission. A lot of these players have been left for dead because no one cares about them because they're not the shiny future object. They're the boring legacy object, but that they are going to have many, they're going to have, in my opinion, the internal combustion engine won't be going away. We'll be into the 2300, or sorry, not 2300, 2100, excuse me, and there will still be new internal combustion engines being produced. It just doesn't. Look, maybe I'll be wrong on that, but I think the runway for the legacy products and suppliers is going to be a lot longer than people think. Even though I would agree that EV adoption and mix of new sales is just simply only going to continue to rise. But yeah, I mean, and the prices are pretty compelling, right? Like with all of that, if you're in California, you can get up to, what is it, 15,000, 7,500 from the federal government, 7,500 from the state. You can get a Model 3 for $25,000 new net of that. Then of course, price drives a lot of those decisions. So
yeah, on the commercial side, right? So I've started seeing a lot more of the Amazon Rivian trucks, and
yep.
I stopped and talked to a couple of the drivers, and they've had no problems. I mean, for the stop and go, that whatever it's 70 miles or something is
Yes.
apparently what they do in a day or in a run. It's plenty good for that, and I think that's. It's very surprising that given the amount of research Tesla has done on the market, that they did not, fill that in quickly. And I think that's probably the only reason Rivian is still relevant.
Yeah, I know we talked about it a couple of weeks ago, so I don't want to say all the things I said then, but that's exactly it. The economic case for a step van to be electrified is compelling and has been compelling for years. If Tesla really truly wanted to electrify commercial vehicles, they would not have done the Semi. They would have simply built a step van product, and UPS and FedEx and USPS would have used those because the total cost of ownership, fuel is a very significant expense for that sort of a stop and go operation. The vehicle is idling. Of course, internal combustion does very poorly in low speed and high idle type, whereas an electric motor is not consuming any material amount of energy when it's just sitting there. The stop and go aspect of it, the regenerative braking is able to shine, whereas if you're on just cruise at 60, 70, whatever miles per hour, that's where the internal combustion engine, the diesel engine, really shines. And the relative efficiency of the electric motor versus the internal combustion engine, you just don't get as much of a benefit in that sort of a duty cycle. So again, coming from someone who worked at the largest truck leasing company in North America, seeing the lack of focus on that lighter duty application from Tesla was just very surprising to me. And I don't know what the logic was. I know that the hope had been that Tesla would be able to use the Semi and its internal supply chain needs from Sparks to Fremont and kind of have the Semi satisfy carrying those packs from the Gigafactory to the assembly facility in Fremont. But other than the handful of trucks that have gone to PepsiCo, again, we just don't hear much about it, right? It gets touted by sell-side analysts about how Tesla Semi is going to disrupt Daimler and all of the other truck makers, and that's just not been seen.
Well, Ives doesn't qualify anymore as an analyst, right? He's just a Tesla shill now, so no point even talking about him. But yeah, I'm with you on this. Some of their decisions seem so interesting and so far, out their futures thinking, and some of them are like, what the heck were they thinking? So anyway, I mean, look, I'm not negative on Tesla. I just don't. There is a price for where the valuation is compelling, and we're probably reaching the upper end of that right now in my for me, for my risk profile.
Yeah.
I can see it as $1 billion company in a year, but I don't see it as a 8, 10, 12, whatever between Ives and Kathy Woods. The numbers they come up with, I don't see those.
Well, what you just said, Monative, and I don't want to keep you the one who talks. I really welcome the other folks and anyone who's listening to chime in. But there's a price for everything. There's a price where any investment is unattractive, it's too high, and then there's a price where it doesn't matter how horrific the business is, the price is too low. So I think the issue is a lot of people forget that. They get very emotionally attached to companies that they've chosen to put their capital into. And they forget that the thing that matters, the most important thing, are your risk adjusted forward returns, not what's happened in the past, not your cost basis. I had put a survey out, a Twitter poll out, and I was very surprised. I guess I shouldn't be. I was very surprised to see. I'm just trying to find what the results were. I had asked, how much does your cost basis impact your thinking about a stock's prospects? And a little under 200 respondents, but unfortunately, more people responded that their cost basis has a significant influence on their thinking about a stock's prospects than responded to the combined total of just the tax considerations, which I think is the right answer. And it doesn't, which if you don't have tax considerations, then it doesn't. So I'll ask that question to the panel. How much does your cost basis impact your thinking about a stock's prospects? Why?
For me, honestly, it's nothing at all, because if my I mean, you're an investment with a thesis. If that thesis is still valid, then your price should be your cost should be lower than than the current price. If it is challenged and you still have reason to believe that the entire market is wrong, you're right. I would say first thing, look at your thesis again, right? So I mean, it's sunk cost. First of all, that's money you've spent. It's not like you're going to have to try to recover it from that particular stock. You need to recover your capital. There's probably hundreds of opportunities that are better than where you're in a hole already. So to me, it should never matter. I mean, unless I suppose if you are really deeply in the money, your cost basis matters to how which lot that you dispose of first. That's a different way, angle to that altogether. I didn't think about it when I answered earlier. But yeah, if you're extremely profitable on a stock, I suppose your cost basis matters to decide which lot to sell.
Yep. Okay. Well, I think we've gone through all of the material, including some other random things I brought up that I had kind of prepared for this afternoon's discussion. It's 5:07, so I'm happy to keep this open until the bottom of the hour or through till 6, depending on how much conversation folks want to have. If there's any topics that anyone who's a speaker wants to bring up and discuss, or anyone who's listening wants to ask any questions or otherwise, please feel free. Jiro, please go ahead.
Okay, cool. Yeah, last time we spoke together with Mickey. Mickey is not here unfortunately today, but Monetiv wrote, you were also present, and we discussed the topic of liquidity. And I think what I didn't explain well is why a drain in liquidity is actually affecting, how do you say, like the stock market or the Nasdaq or whatever, right? And there's always this analogy, and there are these memes outside, right? That I don't know, that it's like water. How do you say? It's like water pumped out of the top or something. Yeah, I mean it's a very nice analogy, but that's not really what is happening, right? Like what is basically happening is, number one, it's all about the reserves of the bank reserves, the bank money, and why? Because like if a treasury how do you say, if the treasury needs money, it can get taxes, or it issues bills, and by issuing bills, you, me, and anybody in this space cannot buy the T-bills, right? It is one of the 24 primary dealers. It's one of the big banks, Goldman, Deutsche Bank, I don't know, probably also Societe Generale, BNP, whatever, like the big names. They can buy it. By them buying it, they are actually moving cash to the treasury, and for that they get the securities, right? The T-bills, and that's actually what's happening, right? It's just a move of bank money, and so why does it affect the stock market? I thought about this actually. It is actually it has more to do. On one hand, we have the fundamental reason, yeah, that if all else equal, then actually interest rates should go up, right? Because you have much more supply. If the demand stays the same, and the supply is much more, you have to reward investors much more. So interest rates should go up a little bit. So that's one reason. Because why? Because when you are investing in Nasdaq, it's a very long duration asset in the how do you say, within the Nasdaq, so it's discounted with a higher rate. So that's a tiny reason actually, right? But that's one of the reasons. And another reason, I believe, is because there was also the question from Mickey. I think he asked if people out of a sudden don't invest in Apple stock anymore, right? I mean, when we talk of retail investors, right? And if a retail investor is always investing $500 or let's say $200 per month into a Nasdaq ETF, the triple Q, if they would change investing from triple Q into T-bills, right? But that's not really what's happening. So it has more to do with institutional investors, right? The big dogs, and they are rather moving away from stocks into bills when they can see that interest rates might go up a little bit. So I hope I explained it a little bit better now. I don't know. I don't know. What do you think, guys? Please ask me any question. Because
By the
yeah,
way, Jiro, I added a
yeah.
pin.
Cool.
Concodonomics had put this tweet out a couple weeks ago. I thought it was helpful to kind of visualize that whole the whole moving, I guess, parts of the treasury space. So
Yeah, because that guy is a legend, Rod. That guy is actually Zoltan Poza, and he is the Credit Suisse guy, with his big picture topics. I don't know if you
hang on,
ever
I
heard of
didn't
him.
notice. You're telling me that that's
Yes,
Zoltan's burner account?
he's Zoltan.
When did this get this? When did this come up?
I think I think the other account, Sir of Finance, announced it, and then Conda actually commented below and asked if that was even a secret. No, it's really him. It's really him. I
Huh.
mean, because Credit Suisse was bought by UBS, right? And it's actually said that Zoltan is not working for Credit Suisse and UBS anymore, right? So it seems like he left the industry, but it's good to see that he's still active on how do you say, on his Twitter handle. Yeah, but I agree that him and Andy Constant are actually the two money market guys that I follow. If I don't understand things, and to be honest, like the topic of liquidity is way more complicated than that, right? Way more complicated. But it's just I try to visualize it in my head also a little bit, like what is happening, because sometimes an analogy or a meme is nice how do you say, to visualize things, but it gives the wrong impression what is really happening, right? And I think that's also the reason why, if we go back, because QE, for instance, right, like since 2009 or 2010, is actually the reverse, right? You put liquidity into the market, right? So in theory, it should increase bank reserves, and bank reserves were also increased, right? And it should stimulate the economy and whatnot, and that didn't happen, right? So also the reverse can be also true, right? So okay, liquidity, or let's better say bank reserves are leaving, how do you say, like the banking system, but that doesn't automatically mean, that how do you say, that automatically that the risk assets will go down, because the reverse was also not true.
Yeah, I know we talked about it a little last week. I saw Nick Timmeros had tweeted, I'll pin his tweet, kind of talking about where some of that, I guess, liquidity's been going.
Maybe just with respect to, because next week we have the CPI print, right? So, and I think that's also one of the reasons why equities are a little bit rage bound. And I think until Wednesday, we should not expect like huge moves in the equity market. But I'm actually more curious about if there will be a story leaked into the Wall Street Journal. And I'm also wondering if the Fed might leak information differently going forward. Because the last couple of times when they leaked something, it was in the Wall Street Journal, right? And I don't know when that was. It was when 25 basis points were priced in by the market, that out of a sudden out of nowhere there's a Wall Street Journal story, right? And then it really happened, right? That it was 50.
Yeah, it was Nick Timmeros, right?
Nick, exactly.
Yeah. So just a couple of thoughts on that, right? I agree with you. I think we're probably range bound until we hear from the Fed. But going back to your earlier point, I think sovereign wealth funds are probably going to start, weighting, treasury instruments more than they normally have. 5.25%, 5.5% is a big return for them, and with the level of, so, and it brings down their overall portfolio risk substantially if they increase the percentage. So it's probably a great deal for them. Also pension funds. So I think there's a lot they can absorb. I don't see any issues with massive TGA refills being absorbed. There's plenty of money at the sovereign wealth funds, at the pension funds, at larger funds to absorb all that beyond the central banks themselves from other countries. But I think the story, going back to the Fed from here on out, right? I think the story is going to be, how they, well, first, whether there is unanimity on anything going forward, right? Right now, to date, it's really been, Powell's opinion, and there's really nobody so much as offering even a slightly different view. It's been like, yeah, we are doing this, we're all agreed, and we're all on the same page. I doubt that is going to be the case going forward. There's probably going to be people on either side pushing an agenda and sort of agreeing but dissenting, somewhat like a Supreme Court opinion where people write an opposing opinion also. So you'll see Nick probably getting some of that out earlier, because it takes 6 weeks or so, from 4 weeks from the date of from the FOMC to get the minutes, right? So I see that, and I also, so it's going to require a lot more from the Fed to justify every increase going forward. It's not going to be we're still fighting inflation, right? So that's a slowly disappearing story. So if they have to raise at this point, they have to justify how they think that the impact of all their existing rate hikes is already priced in, and they still see, and where they see those price pressures that need to, that justify keeping the or going further in rates. Keeping it in place, I think, is the simple uh, uh, default status that they're going to fall back to after they discuss, the two extremes of it, right? It's like, we've bumped it up by 300 basis points in a year, and we've not seen the full effect of that flow into, so we don't have to raise, or we're still seeing it, the rates, the inflation higher than our 2% target rate, so we have to raise, right? Those are the two sides of the opinion that they have to balance out. I think you're going to see there's an extreme pressure to keep it where it is and not move it. We're still a little bit away from any chance of a decrease, in my opinion, at least. So that's how I see it, and I think the first couple of no hike meetings, you're going to set a new output from the Fed minutes. So those are going to be interesting. So we can compare forward after that. Is it still, because so far, right, we've been parsing, a rate hike cycle, and we've been comparing to the previous statements to see, what has changed in their thinking. Now we have to, we're going to get this one, and if it is stay pat, then it's a new set of notes that we will have as the basis to compare going forward, and that's where it gets interesting for me. Anyway.
Yeah, I thought because the Bank of Canada and the Royal Bank of Australia unexpectedly hiked 25 basis points, right? So I'm just wondering if the Fed is also looking at that. And I know that the Fed doesn't like these kind of surprises, where it comes on the day. So that's why I'm thinking. So the Fed will not do it like the Bank of Canada and the Australian Central Bank. They, how do you say, like you said, probably Nick will receive a story if they are considering hiking this time, right? But if we don't see any news article or something, then probably there will be what are they calling it, a skip, and they might hike next time. I was just thinking, to have a new. It's sometimes good to go back and think in terms of basics, right? And also institutional investors do that sometimes, right? That in order to evaluate, if an investment is good or not, we always have the risk-free rate as the basis, right? So that's the easiest investment, or how do you say it? It's a risk-free investment, right? It should return the lowest return, right? And so if we look here, 1 year is at okay, I hope I'm not lying right now, is at 5.2%, yeah. The risk-free rate, right? No risk whatsoever. Just buy it and hold it 5.2%. And then we have US high yields at 8.4% yield. Yeah. So 5.2, 8.4, okay, maybe 3%. But that's fairly risky, right? It's like a high yield index. I wish I could find the bloody corporate the investment grade one. I'll try to find it later.
The
Yeah, but
investment grade spread right now is only
no, the high
170.
yield, the high yield is at 8.4%, right? So it's 3.2% above Treasury, right? Does that feel a good, how do you say, a good trade-off? Like if okay, so I could invest in a risk-free bond, and I for sure get 5.2% for sure if I hold it until maturity, right? I mean, it's just a year. And if I go more risky, I only get additional 3%, or what was it, or 3.2%. Uh, it feels like if we compare the risk-free rate with other asset classes, right? Like it's actually not really attractive. So I again agree with Monative that probably institutional investors think like this, right? They think in terms of risk-reward trade-off, right? And it's like compared to the risk I'm taking, if I move to high yield or to equities, right? Actually, actually, the risk-free rate is very attractive. That doesn't mean that equities cannot rally like crazy, right? Like in the next 12 months. Uh, but I'm just wondering in terms of positioning. It's actually
Well, Jiro, wouldn't the other
yeah,
consideration for positioning be,
yeah,
yeah, I agree with what you're saying theoretically, but the other reality would be if I'm managing other people's money and I've been lagging because I am benchmarked to maybe
yeah, yeah.
S&P, but
True, true.
I was underweight mega cap. Now I need to chase. Now I'm trying to save my job. Maybe I'm not really concerned about the reality that the forward risk adjusted, you know, return expectations of buying that mega cap tech or that high yield paper is I'm not as concerned about that. I'm more concerned about making sure I don't get left behind.
Yeah, yeah, but that's more. But that's more if you are, let's say, a long only equity portfolio manager, right? But if you are, let's say, a pension fund, like a huge reinsurance company, a huge pension fund, then I think, or not, I think. Actually, I know they have investment committees. Yeah, they meet like. They meet once a month or every quarter. It depends. Like the quarterly is the big one, right? Where they decide, okay, how much do we want to allocate in equities, fixed income, in alternative investments, and then also regional allocations, right? So the big dogs are really thinking in terms of regions and also factor exposure, of course, right? So for them, I'm just wondering, the big dogs might really compared to let's say compared to 2 years ago, I'm pretty sure that their bucket for T-bills is way higher right now.
Absolutely, right. That's what I was saying earlier, and they're going to have a large, issuance by the Treasury to be able to, take that even higher, right?
Yes,
As
yes, even more attractive, correct.
25% ago in the market, even then the allocation would have been, higher than it was 2 years ago. But now with the market having run up this much, the risks on what they hold is pretty high. So I think they'll be de-risking, especially the like I said, pension funds, sovereign wealth funds, insurance companies. If you just look at S&P earnings, right, then just look at the financials of S&P companies. There's a whole bunch of companies there that don't even make enough money to cover their interest payments. So it's not. I mean, the corporate bonds, I think, are still, they're not fully priced in for the risk that they carry. So I wouldn't. 300 basis points is not enough for me to take that risk personally. If I was, a big family office managing 50-60 billion, and I needed to put 20% of that into bonds, I would just take the 5.5, 5.25, and not try to reach for that. I'd
Yeah,
probably
yeah,
have a
yeah.
slightly, yeah, you know what I mean. But basically, it's I think they're going to eat off the corporates rather than off stocks first, right? So
Yeah, yeah, and also what you get if you're invested in bonds. Let's say if you go further on the curve, let's say you don't buy a 1 year, but maybe a 3 year one, right? You still get 5.3%, and then if you had recession, then you would even have much more than this 5.3%, right? Because then the bonds would rally, and you would get duration exposure on that as well, right? So it's actually if you are also a little bit worried about the recession, then it's a very attractive risk and reward actually.
balance that out against one thing, right? We've been talking for a long, or not we,
Yeah, I
we've
agree.
been
I
talking
agree.
a long time about the dollar. So they have to balance out. If the dollar falls, then some of that return is going to be eaten away.
Yeah, correct, Moitif. I mean, because you know me, that I'm not, that I'm actually, I think we are still on the path of a soft landing, right? But I'm just thinking in terms of like, how do you say, like all these big dogs, right? They have to think about the recession because if they are not prepared for recession, then they will. I mean, then they really face career risk, right? if they if if they didn't increase their treasury exposure right now, and if something happens, right? I mean, for us, it's maybe a little bit easier if it's our own money only, right? But for an institutional investor, I think they need to be positioned, even if they thought the same way we think, because it's just hedging their career basically.
Yeah, and even tech companies, right, in their treasury accounts probably have $1 trillion in cash.
Yeah,
So that's a
yeah,
big, right?
yeah.
And
But
for
it's
them,
crazy,
they
right, Monatif? Yeah, yeah. Sorry. I didn't want to interrupt you. Please go ahead.
no. I was just saying that's an easy decision for them to park it in treasury because they can roll it 3 months, 6 months, 9 months, whatever it is, short term, right? Before and they can manage their capital allocation against their treasury very easily. So I think there's a lot of buyers for the treasury at this price, and I think almost all of them are going to be increasing their allocation as a percentage.
Yeah, and also it was not such a long time ago. It was just a couple of years ago when Kathy Wood was on all the shows, CNBC and Bloomberg, and she was also talking that more and more companies are putting Bitcoin in the balance sheet, right? I mean, and for us it seems like, oh, it was a complete different time. It was such a long time ago. It was just a couple of years ago, right? And it's just interesting because of course, like back then, treasuries yielded nothing, and also Bitcoin had this attractive characteristic that it was not correlated with the equity market, right? Or it had not. It had a very low correlation, if I'm not mistaken, around zero. I don't know, maybe 0.03 or something like this. Um, but it's just interesting how quickly times actually change, right? Because now all of a sudden the treasury is the sexiest asset in town.
Yeah, it's almost been a generation since you've seen that, right? I mean, I've been around long enough, but for people that entered the market 10 years ago, treasury was not even an afterthought.
Yeah. Maybe just one information with respect to S&P 500. I'm looking at the earnings. How do you say it? Like the earnings forecast, the forward, the 12 months. Like it's. I mean, I guess it's a average of the analysts, right? So they are estimating actually that what is it? February 2000.
There's some
Okay,
pretty hefty earnings growth from the fourth quarter
it
into
is right.
24 and on, right?
Yeah. So I'm a little bit. Yeah, it's the same. It's the same story that we had for a year and a half, I would say, right? That the bond market is still, and to be honest, like the bond market is not really pricing a recession. You know, when I hear this, the bond market is pricing a recession. That's absolutely nothing. Like, like if the first cut is priced somewhere in September or whatever. Let me actually, before I tell bullshit, let me actually check. If there is a recession, we will not cut by 25 basis points or by 50 basis points or by 75 basis points. We will cut per meeting, yeah, like 100 to 100, minimum 100 basis points, right? I mean, the Fed will not mess around, you know, if let's say if not the regional bank, but JP Morgan has an issue. I mean, I would be very surprised, you know, if the Fed doesn't cut at least 100 basis points in a meeting, at least. Let me check. Yeah, so current pricing, I mean, it's literally almost nothing. Like currently we are price. Yeah, I mean, we are not even pricing a proper cut actually the whole year. So, I mean, we are pricing one more hike, I would say, and then from there, yeah, half a cut. I mean, okay, so I guess the current market pricing is that we are not cutting and hitting a recession. So update, it seems like the bond market is also not seeing a recession this year. I mean, looking at the pricing, right? I mean, they are also not. What do you call it? Like Nostradamus.
The part I just struggle, Giro, with squaring is the expectation that earnings continue to grow from what is already above trend, long-term trend levels. Like it's basically such that there would not be an earnings recession. Earnings never return to long-term trend. Earnings just continue growing above long-term trend. That seems to be what is priced and what has to happen to justify these prices writ large.
I mean, I'm only seeing now these earnings estimates, and it's not like that they are forecasting that it will like rebound like crazy, right? It would still be below the highs, of course. I think. I mean, of course,
Which is very
if
easy to
interest rate.
forget that those highs were induced by
Yeah,
extraordinary
okay.
stimulus, right?
Fair point. Very fair point. I agree. Yeah, but I mean, let's say, okay, let's say we really hit the last implied CPI pricing, right, where people really trade inflation basically, was that they saw in October, I think already the first below 3% headline print. Yeah, headline. So core still around 4%. I mean, there is no pricing for that, but there was a forecast from Citi, I think. So I'm just saying, I mean, if we really are heading into a super soft landing scenario, right? Then actually, and interest rates normalize, then I mean, let's imagine that. Like, let's say at the moment the 1 year is 5.2%, and interest rates if they come down to 3%. I mean, that's gonna push the whole equity market up. Oh, because Michael Cantor is here, I'm not allowed to speak so bullish anymore, I think. No, I'm just kidding, Michael.
As far as the estimates, right? I think it's just a matter of time. They've not been brought down yet. I think they'll have to be brought down. I think it's way too positive. So I'm not saying across the board they need to be brought down, by a certain percentage everywhere, but it's got to come down.
We all know, though, that no analyst is going to be the one who goes out on a limb and says that we see meaningful deterioration ahead of it happening. You're much better suited to stick with the herd than step out of line like that.
Yeah, and unfortunately, right, the last couple of quarters it's paid off for them because the earnings are handily beating the estimates. So even less incentive for them. But certainly, I think I guess the first quarter that we close where earnings come significantly below is when they'll meaningfully change everything going forward.
Hi there, Tyrus. Did you want to chime in?
Yeah, good evening, everybody.
All right. Well, just to kind of recap, we started at 4. We talked through some of the material, including both of the SEC actions taken against the 2 illegal exchanges. We talked about this notion. We obviously kind of latter part of this conversation has come back to this notion of, is this quote unquote, a new bull market, and are these equity price appreciations commensurate with underlying earnings growth or what? Talked about a few other things, but gonna probably wrap by 6 o'clock. If anyone who's listening wants to chime in on any of the items that we've been discussing, we talked about electric vehicles. We noted that Bloomberg's new BNF's annual electric vehicle outlook had come out this week. We were talking a little bit about the two major American OEMs opting to begin adapting the Tesla charge standard onto their vehicles later this decade. So yeah, Steve, I know you'd come up and hadn't chimed in yet, and I know we've talked in the past about Kathy's lovely Tesla models, but did you want to chime in on that or anything else?
Yeah, I know. I didn't want to talk about Tesla this time, but I think somebody talked about the you guys talk about the network charging model for like 200 billion run rate. Uh, that Goldman model they actually published I think during Q2 of 2021. So they did a table study on the charging network, basically the amount of people who charge it, and then the charging station. So I'm gonna assume the model is gonna be and the TAM is gonna be larger now than whatever before. But I'm not gonna talk too much about it. I don't think Kathy Wood's model had that assumption. Just FYI. But you guys can
Well, it
maybe.
sounds like there's some upside then that Nick and the ARC team can pump those charging revenues up.
I know, right? Okay, so I wanted to just focus. I know next week is gonna be focused mostly gonna be CPI and then FOMC stuff, but I just want to talk about. I remember I talked last time. I talked about Nvidia and AMD. So next week actually, AMD is gonna host the event I was talking about on 13th, so it's gonna be Tuesday, I think, and then it's actually a pretty major event. I don't know if anybody paid attention to it. So they're going to launch Family, their Bergamo and Turum chips, the next generation platform. It's actually ultra competitive, I think, in my opinion, if you compare data compared to Intel's next generation chips. So basically, the 128 5 nanometer chips is gonna be based on the Zen 4 platform, and then compared to the Intel, they're like way behind, right? So they're looking for like next second half. Well, maybe that's what we're looking at, but the next generation 3 nanometer Turin platform is gonna be an even more competitive platform, which I don't think Intel have that type of solution yet. So it's gonna be a huge event, I think. And then I think they're also gonna showcase the MI 300 platform, which is like a CPU and GPU accelerator. So that's a NVIDIA competitive product. So NVIDIA have a similar accelerator products, but obviously, like I said before, NVIDIA has more market share in the GPU space, and then the NVIDIA been dominating the whole time. But I'm just saying, I think there's gonna be some sort of prospect for Intel in terms of capture some of it, and then and they obviously they're gonna talk about the different AI implementation. There's not a chip company, Marvell, right? Marvell, they're the leaders in the in terms the space in similar space. But I think AMD has a lot of sales channel to compete with them, right? So the DPUs for Marvell is like the data processing units. I think AMD also offer like a range of DPUs for their own products. So yeah, I think it's gonna be a big event in my opinion. Obviously, it can be overshadowed by all the microeconomic headlines, whatever's gonna happen next week. But just to keep eyes on that.
Yes, thanks, Steve. It's a space. Everybody who's tuned in any of these knows that it's not my wheelhouse. Monative, I don't know if you would add anything to Steve, because I know you know the space. I think probably better than most of the rest of us on the panel.
So again, it's going to be an interesting product announcement, but their last one after their earnings was sort of underwhelming. They're looking forward to a lot of these launches in the future. So I'm not. I will hold my thoughts until I see what Lisa has to say. Look, they've done a good job so far the last few years. So I'm not. I won't be surprised if they come out with a strong product line. But data center itself is not where the money is, or the big rush from the retail investor is these days, right? It's going to be that massive margin that Nvidia is making from their A100s, the GPUs. So AMD does not have a product there, is not likely to have a product in volume this year. Even if they announce something, it's going to take a while to build up volume and get it into the pipeline. And then they have to have the software stack, which the lead is even greater for Nvidia. So I'm not hyper positive. I think they will do just fine, but I'll hold my judgment till I see what they announce. Um, AMD has done great so far, so I doubt that they will lose market share at this point. Whatever Intel is going to gain is probably year or two out still. I think they will probably stench the bleeding in a year or so, and then they have a long road to claw back. So I'm still bullish on AMD. I'm not. I don't have a position. I think it's. I'm not going to open a position at this price, but I'll be watching next week. And like Steve said, I think most of the oxygen is going to be sucked out by the macro news, right? By FOMC. So Steve, when is the Thursday Friday? Is that the
Thir-
set?
yeah, 13th. So I think it's Tuesday, 1 p.m.
Okay,
So that's I think the day where CPI.
so it'll be right after CPI. That'll be
Yep.
interesting. Okay.
But yeah, I agree with you. They, I was telling you last time they did a pretty bad job on their conference call. So yeah, so it will be hopefully Lisa learned what how to market themselves on you know on Nvidia, but we'll see.
Got to get on Jensen's narrative level. Jiro, go ahead. Excuse me.
Yeah, it's actually a pity that Michael Cantrell left because I had a couple of questions for him. Yeah, okay, so maybe just an update that Goldman Sachs, especially the chief economist Hatzius, was actually very, very good with his forecast so far, right? So they lowered the recession probability from 35%, which was the probability right after SVB, to 25% now. Yeah.
Is that within 12 months or what's the period
Yeah,
that
it's
percent?
always the next 12 months.
Okay.
But to be honest, like this next 12 months is a little bit of bullshit thing anyway, right? Because also when you look at this New York Fed model, yeah, where they only use the 3 months 10-year spread, and everybody's taking that so seriously because it has such an amazing track record and whatnot. And the last print was also because they are converting basically the inversion into recession probability, and the last one was it 68%, and everybody was like, oh my god, oh my god. But it is such a bullshit indicator because it literally just takes how much is the yield curve inverted, right? And then what's the recession probability? But the problem is because in the 1980s, in the beginning of the 1980s, when Volcker increased the rates, I don't know, from 12 to 20%, right? Like that was of course the biggest inversion, right? So you will never ever have again a recession probability as high as in the 80s, because the inversion back then was 3.5%. So this model, I'm a little bit skeptical. I mean, it sounds great, and if you data mine enough, then you will always find something. And I can guarantee you, this time it might not be the 3 months, 10-year spread that might predict it. They might find uh, another parts of the yield curve, and maybe they will also shift the how do you say it, the forecast periods and say, okay, going forward it's 16 months or something, right? I mean, it's pure data mining, in my opinion. But because this indicator usually has a pretty high weight, in all these recession forecasts, I think that's why the recession probability in how do you say that many economists have a much higher recession probability compared to Hatzius from Goldman Sachs. But he argues, but he also has very good reasons for that, right? I mean, he's not just putting out a recession probability to say, okay, now it's just 25%. So he's saying that basically the regional banking crisis, of course, it was stressed, but it will only subtract 0.4% of overall GDP growth for this year. And also he's saying that the deposit outflows have slowed, and overall their forecast for 2023 GDP growth, like overall the year, is 1.8%. That doesn't mean that we might not have a negative print in Q3 or whatever. It's meant for the whole year, yeah. And then also they are also seeing that because usually you would need a recession in order to bring inflation down from such a high level. And they are seeing, because unemployment increased from 3.4 to 3.7%, that the labor market might be already reacting, and that and that's also the reason why the base case is that it doesn't need a recession in order to balance the labor market. And there are a couple of reasons that are very reasonable. Also wage inflation, they have an own indicator how they track it, because average hourly earning is a super shitty index, because it goes up and down like crazy. Because basically what it does is it takes the whole labor force in the whole economy, or all the people who work, divided by the hours, basically, right? But when you have so many people leaving the labor force or being fired, like for instance in the tech sector or in the finance sector, right? So all the higher earning people are how do you say, if they are gone, and then you divide it, then of course the wage growth will be lower, because you're counting the wage of people who earn less. So that's why the average hourly earning indicator is such a terrible indicator. So that's why you have Atlanta Fed median wage growth tracker, and also employment cost index. But the thing that the Goldman Sachs is using their own proprietary wage tracker is also showing that it's trending down from the peak of 6% to 4%. I wish I could have asked Michael Cantrell about what he thinks about recession probability, and what and how high he would put the probability of a recession within the next 12 months. Maybe just a final thing, Rod. I don't know if I talked with you or with Monetiv about. There was a Barron's article last Saturday about the banking system. Did we talk about this already or not? Please hold me back if I mentioned that already.
I haven't discussed today, no.
Or maybe in an open mic session. Okay, then, so basically, it was very interesting that they were showing that the shadow banking system, makes up now 50% of the overall banking system. During GFC times, it was, I think, 42%. So the proportion of the shadow system grew. And what is the shadow system? It's basically a banking services, okay, but it's not done by an official bank. And this long form article argued that, okay, so we saw certain cracks in the regional banking system already, right? But we have no idea what is going on in the shadow banking system. And an example for that is, for instance, if you are, let's say, a private credit portfolio manager, then you meet with companies like mid-sized who are too small in order to issue bonds in the capital market. But basically, okay, so you meet with the CFO of this small to medium-sized company, and you give that company a loan, basically, right? So it is basically a bank, this credit portfolio manager. And the problem is also like if something cracks there, then it's not as easy as selling a bond on the market, right? And calling your broker and asking for a bid ask. But because it's private, you need to sell it probably to a different bank, and they will ask for a huge haircut, right? So it's not the bid ask spread is widening by, I don't know, by 0.5% or something like this. Probably the haircut is then 20-30%. And this would also not be visible very quickly because they also have like the net asset values, if I'm not mistaken, is also once per month, right? It's a little bit like real estate. So that will be very interesting if something happens in the private credit markets. It would come with a lag, unfortunately, because of the net asset values. But if something happens there, then it's quick, because then all the private credit portfolio managers, they want to get rid of how do you say, of certain exposure, and that could get very ugly. Yeah, but the
And
problem
I
is
would
we
add,
also lack
Giro,
total transparency at the moment. Yep.
yeah, I was going to add, I had seen earlier, and just, I guess it's a little tangential to what you were just talking about, but Charlie Bilello had a tweet kind of highlighting the mix of interest-only loans and commercial mortgage-backed securities, and how that mix had risen from below 20% going back to post GFC in 2010 to, in the last couple of years, it's just shy of 90% of those new CMBS are interest only. So in terms of like, I know we've mentioned in the past that that's obviously a space that's challenged, and depending on what slice of commercial, whether it's office and within office, which tranches of office, it just feels like there's a lot of pain that needs to get flushed through that sector. And I don't know how that aligns with private credit, because credit's not my forte, but how would you react to that?
Yeah, it might actually not even be like the commercial real estate sector, right? Because because markets are forward-looking, and if there is something, then it is priced immediately, right? In an efficient market. Okay, we know it's maybe not 100% efficient, but it's fairly efficient, I would say. And
like Carvana going up what percent this week? I just
no, yeah, but let's say with these very big macro topics, and commercial real estate has been now in the news like for how many months now? I mean, basically since Silicon Valley Bank, right? No, maybe a little later, to be honest. But so when it's even, not only in financial newspapers like the FT or the Wall Street Journal, right? But it makes in very standard newspapers also, and I see it everywhere. And I think REITs already. And to be fair, it already repriced, right? It's not like that that there was no repricing at all. So I'm just wondering, like, if it's in the price now anyway, that we might are looking at the wrong part of the market for the next shoe to drop. Because I think if it was really commercial real estate, first of all, we would have seen it in the reaction of the regional bank performance. I think I mentioned in the previous space that PacWest was a terrible performer, and they have almost zero. Zero. No, of course, they have some commercial real estate exposure, but compared to all the other regional banks in the same index, they had very low commercial real estate exposure. So the market clearly doesn't consider, or back then didn't consider commercial real estate such a big issue. But it was more about the uninsured deposits, and it was more about, are you a bank in the west of America? Are you a Californian regional bank, or are you a regional bank in New York, right? So they made a big difference about this also. I guess it has less to do with the region, but more to do with, okay, if you're in California, you have more exposure to startups, right, to tech and that stuff. but if it's not seen in the data yet, you know, if I don't see it in the data that it is commercial real estate, then I mean, how long do we need to wait for that to show up in the data, right? I mean, because
You
of
know, it
course it
started
sounds great
showing
to have
up. The delinquency rates
yeah.
are rising, right? I mean, it takes time, does it not?
Oh, no, fair. It's a very fair point, right? But it's one thing that that a narrative sounds good, and it also sounds very logical, right? It makes to me it makes 100% sense, right? The commercial real estate should be the next shoe to drop because people are not working from because more and more people are working from home. It makes total sense, right? But if I don't see it in the data, in the
No, the data
performance
show
of
that
the
many of
yeah,
these office spaces are at maybe half their pre-COVID like
yeah, it
occupancy
is
rates.
already
Like
priced.
it's
Yeah, yeah,
unsustainable for a
yeah,
lot
yeah,
of these.
yeah, 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 but it has been already repriced, right? But I'm just saying, like, if I don't see it in the data, sorry, let me clarify. If I don't see it in the data that stocks of banks with higher commercial real estate exposure perform worse than how do you say than banks with less real estate exposure or commercial real estate exposure, as long as I don't see that, it's just a narrative and it's not backed by data. That's what I meant. Because one thing, because I also do understand that, of course, narrative helps us to look forward, right? Because data is often backward looking, or maximum what data is that it is what do you say that is a present point in time, right? But it is not forward looking. So I get that, but I think the commercial real estate story has been now out for a couple of months, and equity market still hasn't reacted on that. I mean, maybe that should be even more troubling. I mean, it's also possible that
It
it's
is
even
very
worse, right?
troubling to me.
No, because I'm just wondering. I mean, maybe the equity market is just saying it's not a big deal, right? Or or they are just sleeping on it. But Rod, I cannot imagine that the equity market is sleeping on it when it's in the news and it's everywhere. It has been everywhere for 3 months.
Well, it's okay, Jiro. AI will solve it. Look, it's
Okay,
6 o'clock,
perfect.
so 2 hour mark. I'm gonna wrap because I'd like to get my weekend started. So, Jiro, look, I appreciate it. You just know, I like to be devil's advocate. Monitive, Brendan, Steve, Jiro, everyone else who came on up and chatted with us. Appreciate the conversation as always. Just to recap for folks, we host these every Friday at the close. We didn't do it this week, but we typically host a weekly open mic. I host under my personal account at Rod Alsman Wednesday nights at 7 p.m. Skipped it this week because had another space instead. But we'll be back next Wednesday at 7 p.m. as well as next Friday at 4 for our Wook in review. So thanks everybody for participating in our discussion today. Hope everybody has a great weekend, and we'll talk soon.